Good day, everybody. This is the week ahead in Forex trading. I am Paul Spirgel. I am going to be delivering the webinar this evening. Before we get started, let's take care of a little legal work. Our disclaimer, foreign exchange trading carries a high level of risk that may not be suitable for all investors. Leverage creates additional risk and loss exposure. Before you decide to trade foreign exchange, carefully consider your investment objectives, experience level, and risk tolerance. You could lose some or all of your initial investment. Do not invest money that you cannot afford to lose. Educate yourself on the risks associated with foreign exchange trading and seek advice from an independent financial or tax advisor if you have any questions. Any news, opinions, research, data, or other information contained within this presentation are provided as general market commentary and do not constitute investment advice. Forexfolio expressly disclaims any liability for any lost principal or profits without limitation, which may arise directly or indirectly from the use of or reliance on such information. All right, that being said, let's take a look at some of the key news events that are coming out this week, this evening. Tomorrow, Tuesday, but in Australian time this evening, we've got the RBA cash target rate announcement coming from the Australian Central Bank. We expect that there will be no change in the interest rate. 4% is the level. Tomorrow in the U.S., we have the minutes of the previous FOMC release. Don't expect any curveballs out of this piece of data. The last couple of data, the minutes have shown a little bit more enthusiasm for the direction of the U.S. economy. Keep an ear out for that. If the market perceives any movement or outsized movement in the growth of the U.S. economy, it could have effects on the dollar. And the Eurozone will have producer prices. Wednesday, we have ECB interest rate announcement and press conference. Same story there, not expecting any changes, but again, keep an eye on the language. We have more PMIs coming out. We've got the UK on Thursday having their rate decision. Again, no change expected. For Thursday, I threw German industrial production on there as well because, as we've seen recently, Germany is really the most successful economy in the Eurozone at the moment, so it'd be important to see what's going on in Germany. If Germany catches a cold, and by that I mean their economy starts weakening, that would not be good for the rest of Europe and would also portend bad signs for the U.S. as well down the road. Thursday we also have Canadian PMI, the IV number. Again, expect with the Canadian proximity to the U.S. Being so close and being a major trade partner, expect that to be slightly positive. Friday, the big day, we got UK and German markets are closed for Good Friday. We've got non-farm payrolls, which is the big bogey that people are going to be focusing on all week. The market's expecting that payrolls in the U.S. will remain unchanged at around 8.3%. Again, 8.3, 8.4, 8.2, those numbers are in target. If we come in below 8.1 or above 8.5, we could see some significant movement in the U.S. dollar, particularly against the euro. And again, it's a bizarre week this week. We've got China out most of the week for a festival. Hong Kong's out for a bit. And we've got Good Friday coming at the end of the week. So it's, for the most part, there's going to be a lot of thin trading out there. So I'd caution everybody to be careful and keep some tight stops out there because we could see some dramatic moves. That being said, let's take a look at the week ahead. As we said before, we've got most notably ECB and UK rate announcements coming. We're not expecting changes, and keep an ear out for the NFP. Again, with the Aussie rate announcement, somewhat different. Again, expecting no change, but keep an eye on the language. There's some news going on in Australia that's not particularly good for the Australian dollar. Expect the statement to come out with the RB announcement to be somewhat dovish. Again, the market's already factored this in, but there could be room for further declines in the Aussie. Again, we've been espousing this idea since mid-January that these rate cuts are not good news for Australia, and we've seen a bit of a sell-off, particularly in the last 2-3 weeks. We've come down from 108 and change down to 103.5, so that is coming to fruition. Systemically, the Aussies are also having some taxation issues, and there are some election issues going on. So all's not rosy in Australia, and again, they're significantly tethered to China. So with some weakening China data coming out, pay close attention to Aussie. Again, the pitch at this point in Aussie is lower. Again, unless we get a significant break of that 108.5 level up top, the market seems to want to press lower on that. Tuesday, we have the FOMC announcement. Should give us a view on whether the Fed is looking to be accommodative. The Fed will be turning to a more hawkish stance. The market is under the impression that the U.S. economy is going gangbusters. If you look at those of you who watch futures as well, the U.S. Fed funds future is showing is pricing in an 80% chance of a quarter point move in September 2013. As we all know, Bernanke has said, or Fed Chair Bernanke, to be respectful, has said that he doesn't expect policy to change until 2014, but the market, on the back of recent economic data, is looking to jump the gun a little bit. And there's actually some sentiment out there in the market that, if you notice the backup in U.S. Treasuries over the last 2-3 weeks, the market is trying to get ahead of any significant rate move in that direction. So keep an eye on any changes in U.S. growth. That being said, again, next bullet point, expect no movement on rates out of Europe, cautious language. There have been recent flare-ups in rhetoric, particularly between the Italians and the Spanish. The Spanish are saying that they're not going to be able to make some of the austerity and some of the budget targets that they had said they were going to be doing, and the Italians are calling them out on that, saying that's not fair. So there's in spite of all the LTRO and the EFSF and the rest of the alphabet soup of Europe flooding liquidity and trying to take measures to stem the decline, Europe being what Europe is, looks like some of the nation states are not getting along, and that could have ramifications down the road. All right. And again, as we said before, the U.S. employment rate is expected to remain unchanged at 8.3. And again, 8.1 and 8.5 should be the surprise areas, being a number coming in at or above or below these targets would you would expect the market to make a significant move. Again, with the UK and Germany out for Good Friday, there could be some what they call liquidity traps. Being in a low liquidity environment, there could be some pressure to move one way or the other. But I imagine for this number in particular, it'll be all hands on deck, and it should be a relatively orderly market. That being said, once the data's out, I expect whoever did have to come in just for the number to go home, and we'll see a very early European close, and the afternoon in New York should be very, very quiet. So I would square up whatever you had early Friday, because if you get stuck in something you don't want to be in, it could be a very long Friday afternoon. All right, China PMI was released over this weekend. It showed stronger economic activity. This is in contrast to the HSBC PMI numbers that were out last week. They have different sample sizes, which is why there are different readings on that. The Chinese domestic numbers are well above the 50 area, which is a very positive sign. But the fact that the HSBC number is coming in that much lower, it portends down the road that people may not be taking some of these numbers as seriously as they should for on an integrity basis. If they see two different numbers that far out of whack down the road, there could be some issues. But pay close attention to that. China again is if the world and Europe in particular is going to grow out of its recent problems, which is really the only solution for it, even in spite of all the government stimulus, the Chinese are going to have to play a very important role in that, and a leadership role in that. And as we mentioned before, China is going to be closed most of the week. It's the Qingming Festival, and they come back on Thursday, and by Thursday, as the U.S. is waiting and the world is waiting for NFP, don't expect there to be much activity out of any of the China news. Another significant piece of news coming out on Wednesday, we have a Spanish auction. Pay close attention to this because recent Spanish auctions and equities markets have been particularly weak after showing some good strength 2-3 weeks ago. Interest rates in Spain and to a lesser degree Italy have been creeping up a touch. So that shows a lot about the relative sentiment of the market for that particular area, and it bears watching. Now we come to the U.S. The U.S. remains the leader in perceived economic growth. Today's ISM number at 53.4 was at the top of the range of consensus. They were looking for anywhere from 52 to 53.5, and coming in at the top underscores the positive sentiment in the market for the U.S. and North American industry. Again, it should have knock-on effects for Canada, Mexico, and to a lesser degree Brazil. NFP this Friday remains key. Fed Chair Bernanke has stated all along that his dovish stance and his overly dovish stance, as I'm sure you're all aware, Mr. Bernanke has gone out of his way to negate any rumors in the market that interest rates will be creeping up shorter. He's a staunch believer that the recession or the depression in the U.S. in the 30s was made to linger because the government and the Fed raised interest rates too early, and Bernanke wants everybody to be sure, even if there's not going to be any QE or any twisting going on, that he intends to keep interest rates lower until 2014. But again, if data comes out and shows that the economy starts recovering in a significant way, while Mr. Bernanke has power over short-term rates, long-term rates are out of the scope of what the Fed can handle. So keep an ear out on that and watch for more economic data. Again, as we mentioned, there's still funding pressures in Europe, Spain, and Italy in particular. There's significant refunding going on over the next couple of weeks. Keep an eye on the rates because, again, rates is the canary in the cave that tell you the relative health and strength of the European economy. The FT reported overnight that several major European banks are set to repay their 3-year LTRO borrowings within the next 12 months. That's good news for the banking sector, but the question is still, the sovereign risk is still somewhat weak. The particular, not so much the Greek, as we mentioned here in the past. Greece was really small potatoes, but Spain, the banks that are looking to return the money are some of the more major European banks. And again, it's sort of akin to the situation here in the U.S. when when the banks were repaying TARP money. The Goldmans, the Chases, they were the first to repay TARP. And a good case could be made that the Goldmans and the Chases in the U.S. didn't really need the TARP in the first place. So while it's significant and it sends a nice message to the market, it doesn't really jive with the facts on the ground. And further, we've got the commodities have been down for the last month. They're still positive for the year, but again, we've seen gold in particular as interest rates made their move higher. Gold's been a little jittery about trying to make new highs above that 1850, 1900 area. So again, keep an eye on interest rates of that. We discussed last week that some of these commodity moves are really, the notion of the safe haven move into commodities is such that when interest rates are low, there's really not much decision to be made about whether or not to go into gold or oil, because they'll always have value and you're not losing any money on the lack of carry. But as interest rates start to move higher, the hedge funds will start bailing out of their commodity positions and looking for more financial assets to gain greater yield on. So be cognizant of that as well. And another slide here, some of the European PMIs. What we've had is some of the actual PMIs coming out. The France and Spain are highlighted in red. Their actual numbers didn't meet the expectations of the market. And what this really shows you is the UK being outside of the Eurozone proper, and they've had better economic activity. Germany being the leader of Europe, while they're meeting expectations, they're still below 50, and that's really because all the austerity programs going in with their neighbors is not going to be doing much for their ability to trade with their neighbors. So keep an eye on that as well. The Irish are up again, probably because of their proximity to the UK. Everybody else is below 50, and 50 is also a good number of confidence. So while even the Germans are doing better than the expectations, there doesn't seem to be much good news coming out of Europe. That being said, we mentioned last week that we would try to stay out of euro, again, looking for 133.80 to be a top and 134.80 to be a top, two areas of key resistance. We had gotten to that 133.70-80 area a couple times when we fell off. My expectation is that particularly as we go into NFP and with the holiday coming up, that the euro is a better sale. I'd keep an eye out as a significant level of resistance about the 135.5 to 20 area. If we get a significant break of that or a break of that, I think we could go higher. But for the most part, as we can see from this from these PMI charts, there's really not much good news coming out of Europe. I think North America and to a lesser degree Asia, if these China numbers were for real, is where the real growth is going to come from. And I keep an eye on emerging Asia and the U.S. and the U.S.'s major trading partners being the Canadians, the Mexicans, and again, the Brazilians. Let's see what else we have. Okay, let's take a look at some charts here. Actually, let's take a little break here and see if anybody has any questions of anything I said. Any questions? Anybody have anything to add to some of my analysis of some of the news that's coming up? All right. What we've got here is a 30-minute chart with Bollinger Bands. And again, you can see on the short-term chart, we've really had a rough time getting above this 133.80 area. And we've handled nicely. Again, as I've mentioned before, I like looking at the crossovers in the Bollingers. And again, we went through the middle moving 20-bar moving average, and we stayed above. We crossed, and we went down. So keep an eye on the bands. And I like 15 and 30-minute bands. But again, if you see a pattern somewhere, by all means, develop it, watch it, and if it works for you, trade off of it. Again, I would use 133.70-80 as a good area of resistance. I'd likely try to sell ahead of that, probably half a position, and if I could, in the 134.20 to 50 area, I'd probably look to sell some more. And again, leaving a stop above the 135.5 to 20 area, depending on what your comfort level is. Also, while we're waiting for that 134.20 to 50 area to come through, I would also leave a stop entry below at 132.80 or so in case we get the drop off, and this way you won't miss out on getting the full position in, but you'd be actually able to take advantage of the move after it begins as well. So I tell everybody, don't be afraid to use stop entries on your way in. The conceptually in the market, if you're looking to pick tops and bottoms, the market will always run through on the top side. But when you're doing a stop entry, if you're looking to sell into that, if the market's making its move, then you could get in and keep running for it. So it's counter to human nature to sit there and try to sell on a stop. but once the move starts, you want to jump in and join. To be able to pick tops and bottoms, I'm sure we've all heard it. We all know it's impossible to pick tops and bottoms, yet we all try to do it on a regular basis. So try to exercise caution in terms of leaving those stops up top, or if you're going to leave an order up top, I like to give myself 20 ticks above whatever level I think it is, just to be safe. But again, stop entries are definitely something you should try to get used to placing. They enable you to get into markets when they move. Again, if you look at the chart here, if you had a stop entry in, you would have had opportunity to take some profit. Again, here, if you look at the big moves come in spurts. So while you could sit here and try and pick tops here, big deal, you've sold here, but it doesn't do anything. If we're sitting here and you leave a stop entry above here, or even above this level, which is the middle of this last gap which the market tries to fill in, you could have had some joy. Then you could have thrown a stop in at this level as well. So just something to look at there. And again, other things to be cognizant of in the euro. Again, there's not much good news coming out of Europe. The EU itself was calling for the IMF to boost funds for a potential bailout. Sterling as well. I'll throw a sterling chart up here. It should be a similar pattern. Expect that cable should go a bit lower. Again, there hasn't been much good news in there. Relatively speaking, it's a touch better than Europe, but it's certainly not going gangbusters, and it's actually been a hotter market over the last couple of weeks, and expect that heat will slow down. I would think, again, if we get a nice break through this 160.05 area, say 159.95, leave a stop entry in there and leave a sale around the 160.5-ish area if you can. Europe, to use a poker term, it feels like it's dead money at this point. There's really not much good news coming out of there. Let's take a look at dollar yen. Dollar yen is really taking a back seat. It doesn't have the safe haven status that it once had. It's the central bank is finally getting its wishes in that there has been some weakness. Again, as Europe stabilizes and a lot of these crises all over the world get put down, you'd expect that the Japanese investors and Japanese hedge funds, Japanese postal service, all the big players who have brought money back to Japan, especially now that we've got Japanese year-end out of the way, almost certainly will begin investing overseas again, particularly if yields in the U.S. start backing up as well. So I would look at 81.50 or so as good support, and 80.40 below that is excellent support, which is where we took off on this recent move high, and expect the range to remain between 82 or 81.80 and 86 or so. There's lack of fear there, and by the same token, dollar Swiss has also the Swiss National Bank has maintained that they want dollar Swiss higher, and it looks like they're going to get their wish. Euro Swiss is solidly in the same range. I guess since Euro Swiss has more action these days, it should have gone there first. And again, we're still sitting here 120.35, 120.44. Again, while it's not out there for real, but the S&B is out there at 120, probably 120.25 to 120.40. Again, we're a touch below there now, but they have drawn that line in the sand and they intend to hold to it this time. If you don't want to get involved on a spot basis, if you have access to an option platform, you may want to buy 121.30 or so call, 3 months out there, because if we keep hovering here and the dollar does start getting some significant move, the SNB could conceivably, and there's more talk in the market that the Swiss National Bank may actually boost its peg from 120 to 125. Some are talking 130. something to be aware of. But for now, barring, as we said last week, an Iranian attack on the Straits of Hormuz or cutting off oil or some other sovereign silliness going on, the 120 peg should hold. All right. Anybody else? Any questions at all? Anything anybody wants to look at? I am at your service. All right, let's take a look at gold quickly and may actually wrap up early. Again, gold made a couple of moves down low last week. Let's get even look at a daily chart. Again, down low here at the end of March, but we've propped ourselves up. Again, when interest rates looked last week or 2 weeks ago that we were going down at 240 or so in the 10-year, US 10-year, the alternative being greater interest rate than financial assets, the street was dumping gold. Now, again, there's a little more Spanish-Italian, debate over how to handle their austerity programs and their budgets. China uncertainty, again, U.S. recovery uncertainty. Gold is back up again. As bonds go back down, we're sitting at 218 in the 10-year. So if you have access to it, I don't have access to it on this platform, but if you could overlay gold and the 10-year, you'll see that there's a very high correlation now. So keep cognizant of 10-year relationships to gold if you are playing in the gold arena. But that being said, 1595 should be good support, and below that it's 1540, and then people are talking we could go all the way down to 1380. And for now, keep an eye on 17 and a quarter so as an area of interest. Again, if we pop up through, we could try and fill this gap up. Again, as we say, technically speaking, the market likes to come back and fill gaps. So again, if we get a nice pop up based on this Bollinger, I would say if we go through 1739, we could see a nice pop up to 1786. And again, if you look at the chart here, there are some nice moves here. 1787, 1704, that's a good day's work. You go back to a 4-hour chart, still some nice moves here. Gold, 1686, 660. You can get a good $20 move. So you want to have your stops in the right place in gold because it's not as deep as most of your currencies, but it does get some good moves. All right. Again, I'll take some questions from the audience. If anybody has anything that's on their mind, by all means, any charts or any comments. Again, it looks like somebody had a question last week about the S&P. What's my euro forecast? I look at any move higher in the Europe as an opportunity to sell at this point. I'm looking for 135, 1020 as a pivot area that if we get a move through there, we could run higher. But I still believe that the dollar and the U.S. are going to be significant forces over the next couple of weeks, months, and I don't see where the good news is going to be coming from out of Europe. Again, Italy, Spain, there's tremendous austerity programs, budgets are being cut left and right, and what the world needs is to grow out of its problem, and austerity programs do not help anybody grow out of their problems. China, again, they're doing what they can to flood the market. They have a bit of a drag on real estate. They have some, obviously, a lot of their trading partners in Europe are not trading as much as they would like, which is a drag on China. The U.S., on the other hand, even GM is doing better these days. I mean, there's good news here in the U.S. And again, it's all because of cheap money that the Fed has been floating through. And the question is, when the cheap money days are over, will we be able to sustain that kind of growth? When And that is the question. Banks still have a tremendous amount of bad mortgages on their balance sheets. There's still a fair amount of unemployment. And again, the 8.3% rate in unemployment that we're talking about here, that doesn't include all the drop-offs that Mr. Bernanke himself said is a significant question. So the euro has all those problems and more. In the U.S., is 2-3 years ahead of Europe in terms of its banking problems and its sovereign problems. So and the U.S. has the benefit of speaking with one voice. The Europeans have 17 guys, trying to shout over each other at every meeting. So, until we get some real good news out of Europe, I would take any strength as an opportunity to sell. And again, if you have access to an option platform, you may just want to go out there and buy a 6-month dollar call, a euro put, 125 or so, 122.5. That seems to me the right area. The range will continue between 134.60 and 129.50. Well, I actually think in the next couple of months that if we get a nice break through 129.80, which was the launch pad in our last move higher, and I'll see if I can get that on a chart for you. Well, this one shows it is 130 even, but let's go a little further back. Yeah, here we go. No, go even further back. It's pretty much this move higher once we really got above this 130.20. So I would say look at 130.20 and again giving it a lot more room. That 129.80, something just a touch below 130 is a good area. And again, that move up above was actually started, if you recall, in January by good news out of China. That good news has dissipated. Now, I'll grant you, it doesn't look like the end of the world is coming in the euro, but it certainly doesn't look like the Europeans are going to be getting out of their problems anytime soon. So the market, if you've been watching it as long as I have, the market probes. It's been trying to go higher. If it doesn't finally make that breakthrough, it'll capitulate, and then everybody will just sell off and start again. So I would say yes, that 130 area to 133.80 is a good area on the wide, 129.80 to 134.80. But again, it feels like the market is getting a little tired of buying euros up here between 132.60 and 133.80 and not getting that final move through 133.80. That being said, I think it's going to move lower. But again, keep an eye on 135.20ish or so as a stop area, and try and sell if you can above 134.20 or so with that stop in mind. Thank you, RamFX. And again, like we were saying in the equity world, 1400 and the S&P has held in pretty well. Again, I don't tend to look at the equity charts as much as I do the FX charts, but that being said, keep an eye on that as a good area of support. Any other questions? All right. Well, if nobody has anything else, I guess we'll wrap it up a touch earlier today than usual. Again, let me tell you a little bit more about who we are at Forexfolio. Forexfolio is a team of industry professionals leveraging decades of combined Forex experience. Combined Forex experience, we have members of the staff that are IT people, salespeople, customer service people, traders like myself. Any questions you might have about how you're being treated by your respective broker, we'll be happy to find out if you're being treated incorrectly and take your case to contacts that we have at these specific firms. We are here to serve our customers and our clients, and we understand that it's a very technical industry. We have the expertise, and we stand ready to help you. We have a trading signals program we send out via SMS and email. We have virtual desktops. We have a partner that will run your machines for you with a guaranteed 99.5% uptime. We have EAs that we are constantly monitoring and evaluating and spitting out that have good success. Feel free to contact us to find out about that. We deal with most of the brokers. If we don't deal with the broker that you are using, let us know who it is and we'll forge a relation with them. At this point, we're working very closely with Alpari. They have given us our own specific spread category, which is very competitive, and we ask you to go onto our site. We have a link to Alpari, which will take you directly to Alpari and get you that specific link. If you have any questions about anything I've said or any of the services that Forexfolio provides, please feel free to call us at 1-800-756-7509. You could Skype us at Forexfolio. Visit our website, www.forexfolio.com. You can contact me directly at paul.spirgel@forexfolio.com. Any questions? We strive to get back to our clients inside of 24 hours. Feel free to reach out to us on any issues, be it research, trading signals, our EA service, or just to talk about the markets. And I'd like to thank our friends at FX Street for providing the platform for us and the support, and all of you who have attended and put up with me for the last 40 minutes. I appreciate the ability to discuss these topics with you. And that being said, keep well. Our SMS gets sent as often as we have a signal, which depends on the market. Thanks much for all your help. Keep well, and if I don't see you or speak to you, have a happy holiday this weekend if it's applicable. Take care.